Hey everyone, I wanted to dig deeper into SoFi's loan origination portfolio and the differences between the segments of loans that it makes. Remember, it does student loans, home loans, and more than any of the other two, personal loans. So I wanted to get into the details of that and why it's riskier for SoFi to do more personal loans than either of the other two. And I'll show you the numbers that show why that's the case. So let's take a look at the numbers.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so in its latest quarter, SoFi is saying that personal loan origination growth slowed to 11% year over year, down to 3.3 billion. Also, the balance of personal loans on their balance sheet declined 2% quarter over quarter. So from the previous quarter to the current quarter, they decreased the amount of personal loans that they hold on the portfolio. I'll talk a little bit more about that in detail a little later in the video. Okay, so here is why it's riskier for SoFi to make personal loans. Let me draw your attention to the weighted average annual default rate line item here, highlighted in yellow, the second line item highlighted in yellow. You'll notice the weighted average default rate on a personal loan is 4.8%. And then let me draw your attention to student loans. The weighted average annual default rate is just 0.6%. That means the weighted average annual default rate for personal loans is 8 times that of student loans. More people default on their personal loans than they do on the student loans. Now, there are reasons underlying those factors, those facts. Number one, student loans are not eligible to be discharged in bankruptcy, which is one reason why people continue making their student loans even when they experience difficulty. Also, there are more benefits to making student loans. You get some tax deduction with your student loan interest payment as well. Personal loans, meanwhile, you can discharge in bankruptcy. And then if you're losing your job or your income is decreasing, the first thing you stop paying is the personal loans. Most other things that you have that you're thinking about paying or not paying, there are bigger side effects than if you stop paying your personal loan, which one of the only side effects is that you'll get a lower credit score compared to, let's say, if you have a car loan. If you stop paying your car loan, they'll come and repossess your car. If you stop paying your home mortgage, they'll come and foreclose on your home and you won't have a place to stay. If you're renting a place and you don't pay your rent, you'll get evicted. If you have your energy bill or your power bill, your water bill, any of those, if you stop paying those, they'll shut off your water, your power, your energy. Personal loans, the side effects are minimal. So when people get in trouble, one of the first things they stop paying is the personal loan. And there is no collateral with these. So if you stop paying your personal loan, your lender, let's say SoFi, they don't have any recourse. They can't come and get anything back. They can't come and take a car, a home, there is no collateral. So it's more risky for SoFi to make these loans, and you're seeing it in these numbers. So you might say then, well, why would SoFi bother doing these? Well, because let me draw your attention next to the weighted average coupon rate. This is the rate that SoFi gets or SoFi charges the customers that are borrowing personal loans, and that is 13.8% compared to just 5.6% on student loans. So roughly 2.5 times the interest rate they can get if they make a personal loan compared to if they make a student loan. So you can understand why SoFi has been so attracted to personal loans, making more and more personal loans. Now, that is a risky strategy. But it does come with a higher weighted average coupon rate. Now, I would argue that it's not worth that higher weighted average coupon rate. I would prefer the lower interest rate with collateral. I would prefer making home loans, which SoFi is doing also after the acquisition of a home loan company several quarters ago. But I would be more interested in making home loans at a lower interest rate and car loans at a lower interest rate, because you have collateral and you're almost guaranteed to make money, because even if your borrower does not repay, you can go and repossess the car or the home and you can be made whole. But with personal loans, when the borrower defaults, you cannot be made whole. And then it's performed relatively well. This is a 4.8% weighted average default rate right now during an economic expansion. Where will these rates go to? Where will these default rates go to if the economy goes into a recession or goes into a prolonged slowdown? So that's why it's been a riskier strategy for SoFi to make these personal loans, and they're trying to slow down. As you saw in the latest quarter, they kind of offloaded a little bit and they decreased how many loans they made in this category. So student loans, meanwhile, grew 43% year over year to 752 million, and home loan originations grew by 274% to 336 million. So you could see personal loans only increased by 11%, where student and home loans increased by much larger percentages. And so overall, portfolio-wide, now it's increasing the amount of student loan and home loans, which is good for SoFi stock investors. That's what you would like to see, more of these types of loans versus the personal loans. So management moving in the right direction, and they have been making good steps, prudent steps forward in managing the business. And now that they have the bank charter, they have the ability to hold loans longer whenever it's advantageous for them. So when they make a loan, they have a choice. They can either keep it and service the loan, meaning people pay them back every month, or they can sell that loan to a third-party investor, which then it's all dependent on the investor and the borrower, right? SoFi gets out of the mix. They take a small fee for their origination, and then they're no longer on the hook. If the person doesn't repay, SoFi is not on the hook because they sold that loan. And SoFi has the choice now. It has the option. Do they want to offload or do they want to keep? And given their strong position, they have the option. If they were weaker, if they didn't have the ability, they would be forced to either keep or sell. But they have the option, and that's good as well. So I hope that explains the difference between SoFi's different loan segments. The less riskier loan segments are the student loan and the home loans. Now, the reason they didn't break down their home loan default rates and average annual coupon rates is because the home loan segment is still a very small part of SoFi's overall loan portfolio. Personal loans are by far the largest segment, and then it's student loans. Home loans are a distant third place. Hopefully, if this rate of growth continues, it can rise up to be an equal share of loans between the three and less focused on student loans. Less focused on personal loans, which as it makes that transition, every quarter it makes that transition, de-emphasizing personal loans, the business gets less risky and less risky and less risky, which I like to see, right? When you're making an investment, I always like to consider risk versus reward. I don't mind taking more risk, but I'm going to require a bigger rate of return if I'm taking a greater risk. But if you're decreasing risk, then I'm happy with my rate of return because I was expecting a certain rate of return and your business was a certain amount of riskiness at the time I invested, but now you're making moves and making the business less risky. As an investor, I would be happy with that. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.